Good evening. This is the weekend report review for the Tortoise strategy report for December 21st, 2014. I guess this would be the Christmas edition. The market is in bullish volatile conditions. On an annual basis, using weekly RSI 14, we're at 62 out of 100. That puts us just above the midpoint of neutral. Using the 10-day NDX and the short-term look back of 10 days, we're also in the higher end of neutral at 65 out of 100. Price relative to the 200-day moving average is white bullish at 6.89. Slope of the 50 has improved to green bullish at 0.52. ADX has gotten stronger at 30.9, so strongly trending price action. The ATR percentage is at 1.57%, which is what puts us into volatile. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the threshold between risk on and risk off. The current reading is at 0.80. That's risk off condition. If we take that score of 0.80 and look back 5,000 trading days, and we find the standard deviation and normal behavior, that gives us the risk z-score of minus 2.52. You can see here the 90-day time series of this indicator, and it's gone from almost minus 3 to plus 3 down to minus almost 3. Here we are at minus 2.5, and starting to roll over again and get ready to go up. In each of these cases, there was a strong swing trade opportunity in the VIX XIV pair, starting way back here when it went from minus 2 to plus 1.5, and then VXX was great on an intraday trade all the way down to the minus 3, and then this was a great swing trade opportunity up to plus 3. And this has been some excellent short-term VIX trading intraday with VXX. And so now, as this thing is starting to roll up again, I am going to be well prepared for an XIV swing trade and then a swing trade in some leading symbols. We'll take a look at some of those as they're developing. We are still holding these symbols in the blended monthly rebalancing portfolios. And then here you see the current leaders in each of these different populations as of close of business Friday's price action. ETF2, the theoretical model, is at 40% still, and the model portfolio is also at 40%. These are just a quick look at the ATF13 and ETF32 portfolios using the blended monthly rebalancing look-back lens. You can see treasuries are in the dominant position still, followed by all the U.S. indexes, and then the globals are lagging, with Latin America being by far the worst. And then in the ETF32, which expands and adds to that portfolio, again you see Brazil, emerging Europe, Latin America at the bottom. About half the world market in a cash position. That's mostly the globals. This is the ETF Max looking through this lens, and this is the one that finds the the real runaway leaders in the relative strength candidates, dominated right now by China, biotechs, some healthcare, and some REITs. And then this next chart shows the S&P 500 through the same lens, the top 40 or so. And it also shows the sector that these are members of. So Staples, Edwards Life Sciences, Vertex Pharmaceuticals continues to be at the top, dominating. The ones that are white and green, like Southwest Airlines, may be lagging a little bit now because most of their gains have come from the 6-month return, and they're lagging now on the 3-month. Whereas new candidates that are green and white, such as this healthcare REIT and Tractor Supply Company, are maybe early in their dominance because they are green and white. They have not started to outperform compared to a 6-month look back yet. So that's how I use this to kind of gauge where in the life cycle of growth these candidates might be. So we'd be interested in Whole Foods and Becton Dickinson. Excuse me. This is the market health check from Stock Charts. The vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that have held in the past, which if price collapses, those become price targets on the way down. You can see that it held at 197. The purple lines were price targets on the way up. You can see that we're hovering right here back to the all-time high around 207, and then beyond that would be gravy, new all-time highs. And so we've had this nice little dip and rebound, same as we had this nice dip and rebound. These are the patterns that correspond with those nice swing trade turning points that I talked about with the risk Z indicator, which has been done a good job of giving us a heads up of price action opportunities on swing trades. The dark blue shaded area is the 30-period Bollinger Band plus or minus 1, the river. Lighter blue shaded area is plus or minus 2 on the Bollinger Bands. That's the floodplain. The outer thick red lines are the plus or minus 3 Bollinger Bands. You can see this came down and tested minus 3. Call that a Z trade. On that pattern, using that kind of information, we're looking for entries. When it gets down here to minus 3, we're looking to buy at minus 2 or at minus 1, and playing the reversion to the mean, which catches this nice move here and really caught this one nicely as well. The blue channel is the 10-period regression line. It's a very wide channel because of this funny print out here. But very wide blue channel. You can see the slope of the 10-period regression line is still down. The 30-period channel is also down, but it's starting to stop its downward decline. You can see the time series of the slope function of the 30 in this sine wave. The blue circles indicate places where it hit a local minimum or maximum, or we're across this dotted 0 line. So right now we are right near the 0 line, meaning that the slope of that 30 is almost flat. You can see it's starting to improve. Anytime that slope is above 0, treat that as a favorable sign for the market. You can see the last time it went from negative to positive here, there was still a nice move available. Gave a nice early warning when it peaked here and then started to decay. And then you also see that here when it peaks and starts to decay. That's important, especially once that slope function gets up around 0.4. You can see it got to 0.4 here and then started to decay. That's the 0.4 and the minus 2.2 levels are statistically significant levels of slope. That's sort of the normal band is between plus 0.4 and minus 0.22. Right now we're at the 0. What this says is that we have plenty of time for this to resume its run north, or potential for this to collapse further and come south. So we have not gotten to an extreme. We have just fought our way back to long-term neutral on this rebound of the last 3 days. You can see we were oversold for almost 5 days here, and have now are beginning to approach overbought. You can see the jaws of the percent price oscillator have closed to the from that downside move and have now gotten back to the 0 line. The last time it did that was here, and that's where we had that subsequent nice follow-on here. So this is suggesting perhaps end of the downward cycle based on the last couple 3 days. So this is the market is postured here. to continue for another leg up. If it were to do that, then what we would see is a support here at 197, and which is a higher low compared to the lower low back at 182. And so we got this nice lazy W pattern starting to form, and all the groundwork has been laid for some of that to happen. Looking at the regional report, we still have 6 out of 10 of the global symbols on cash, and the 4 U.S. on buy signals. That's price compared to their 4-month moving average. That leaves the model at 40.60, with the S&P excuse me, better than the EFA, because 63 is better than 52. And then inside the U.S., it's tech at 65, large cap at 63, small caps at 62, and then mid caps at 61. The U.S. large caps continue to dominate. We're looking at the sector spiders here. Only materials and energy are lagging. Everything else is above average. And then staples, utilities, and healthcare are exceptionally above average. And that's sort of been the case all year. Next up, the world market model. Now we're looking at the strength ratings. We have, starting with the U.S., everything is above average, technology exceptionally strong. In the alternate asset classes, treasuries, corporate bonds, and real estate are doing very well. Asia less Japan and Japan are below average. Everything in Asia below average except for Philippines and India. Latin America and emerging markets, not much better. You can see Brazil, Mexico, Latin America getting smashed. Everything Europe is lagging. The strong dollar is still the main story in the currencies. You can see in the business sectors that the U.S. is leading their global counterparts in every case, or it's a tie, and that staples, utilities, and healthcare are strong globally in terms of flight to quality. This is the ETF top 30 candidates based on that ETF2 lens. You'll see a lot of the similar information. It's a different model, but it still is basically using relative strength. So biotechs, healthcare, technology, real estate, more pharmaceuticals, utilities, more healthcare. You can see the dominant story here has been the defensive large caps. This is the Dow 30 looking through that same ETF2 lens. So these readings in green for strength are compared against the ETF Max database. So you can see just how strong these U.S. large caps in the Dow are as candidates compared to global opportunities, with almost half of them in the green and about 2/3 of them above average. That's white and green. Just Caterpillar and IBM in the red, with IBM still suffering its red and red here, strength and consistency. So what I'm looking for here is Pfizer and Goldman Sachs are in the green and white, so that may be early in their strength, because strength precedes consistency. And then Microsoft and DuPont are both white and green, so perhaps they're lagging a little bit. The yellow and white are ones that are weakening relatively, so I'd be cautious on these. GE, Boeing, McDonald's, AT&T, and Verizon. Now Chevron should be of interest because it's yellow and red, meaning that it may have turned the corner early, and we may be seeing that early in its phase. So we're going to take a look at CVX as an opportunity. So if we're seeing something like a bottom, closer to the bottom in oil than the top than Chevron making a turn, should be of interest to us. Perhaps we can look at buying some quality on sale. So we'll take a look at them. Just the ETF liquidity stats. These are the top 30 based on average daily dollar volume, and the ones that are exceptionally volatile are noted here in green, so that makes some very good intraday candidates. Energy, the VIX, Brazil, gold miners, oil and gas exploration, and oil services. Shifting now to the daily report. You'll notice we have a signal here in Latin America on the short side. I would be ready to take that upon evidence of weakness. You can short the open, but I prefer to see signs of weakness before I pull the trigger, and then trade that as a swing trade one day at a time. But your results may vary. You notice the S&P volatility chart here. This is the ATR divided by price as a percentage compared to the last 100 days, and you can see that we are now above the green line. That's what puts us into volatile conditions on a relative basis. No swing patterns per se, with the exception of a 551W in silver, and then a whole slew of candidates that meet the 2-to-1 reward to risk ratios on the basis of the auto framer. So there's some quality setups inside here that we can look at as well. Only a couple frog candidates here because of this recent volatility. That's Alcoa and Microsoft. 4 symbols meet the auto framer: Caterpillar, Verizon, Alcoa, and McDonald's. Nothing fires on the RSI2 because of that nice run-up of the last 3 days or so. And just a handful of dojis to consider. Also notice these, I'd like you to notice these breakouts over here. On the NDXs, this is the 10-day, the 1 month, and the 3 month. So if it closes higher than the trading range of that previous look-back period, whether it's 10 days, 1 month, or 3 months, it'll score above 100 and then turn green over here. So Procter & Gamble made a slight breakout at 101. Home Depot, very strong move, closing with a 112. What that means is that's if you took the last 10-day trading range and then took 12% of that and tacked it on the previous 10-day high, that's how much higher Home Depot closed above the previous 10-day trading range. So we'll take a look at Home Depot for sure so we can see what that looks like. And you can see that it also made significant breakouts on the 1 month and the 3 months because of the color code. And Chevron also made a nice move on the 10-day, making a new breakout. Okay. This is the ETF 30 looking through the same lens. Excuse me. Nothing on the RSI2, no frogs. Half a dozen good dojis. Plenty of auto framers that are better than 2-to-1. You can see that we had some breakouts in U.S. real estate, and then in the S&P 500 utilities and the Russell small caps. So that might be some front-running speculation here, maybe some health coming to the small caps for the new year. They suffered so much this past year relative to the large caps that it makes me wonder if we're going to see a rebalancing effect where profits from large caps are going to be routinely and automatically rolled into other asset classes that may benefit from that selling, like small caps. So it wouldn't surprise me to see small caps come back strong this year. The 2 winners in price percentages on Friday were oil and energy, the VIX, the big loser. Here's some candidates using the auto framer and the RLFF. Now, these are 2 strategies for finding candidates that are based on trade location purely. And so when we're in the middle of a rebound like this and some of the formal patterns don't fire, then these become a nice way to find things that still have life left in them. You can see gold, at 6.8 reward to risk, and XIV at 5.5 to 1. Caterpillar, Silver, Brazil, a lot of the usual suspects, Latin America, McDonald's, Europe. The RLFF, on the other hand, as well, the auto framer is taking a look at the price action from Friday relative to the last 10 days, 10-day high, and then yesterday's low, and is computing some reward to risk on the basis of that shorter term context. The regression line fractal framework is taking a look at things on the basis of their 10-day regression line compared to their 270 regression line. We treat the 270 regression line as the long-term fair value. That's the estimate of fair value by long-term holders, let me put it that way. And then the RL10 we take to be the consensus of short-term traders. And so if you have a big difference between the RL10 and the RL270, you have a significant difference of opinion about the value of that symbol between the long-term holders and the short-term traders. And that tension in the difference of opinion of fair value gets resolved one way or the other with a decisive move quite often. So we like to find those that are the most numbers of ATRs away from their 270 regression line, because that represents an opportunity for the market to readjust those opinions and bring them back into harmony. Now, either the short-term holders are right and the long-term guys are going to try to catch up, or all of the energy that propelled the short-term trade away from that long-term value will have dissipated, and then the price will tend to drift back towards that 270. So it's like a reversion to that long-term mean. If we treat the RL270 then as the mean to which things regress, then that becomes the basis for finding extreme conditions on either side of that regression line. And that's what this does. So those in the green are the ones where price has been beaten down the most away from the 270. And then we express that distance as a function of each symbol's ATR. So now we've adjusted for its relative volatility, and now we can find relative opportunities and reward to risk using this fractal framework. So Caterpillar, for instance, is 7 ATRs below its 270 regression line. And then on the upside, these are the relative strength leaders. These are the ones that are the most furthest advanced above their 270. So that would be Visa and Walmart at 6.5 and 4.5 to 1 respectively. And then we're just looking at 5 different populations of symbols here. The Dow 30, the ETF 100, that's where I do most of my fishing. The S&P 100, the NAS 100, and the S&P 500. So you can actually start getting some significant divergences as you go out to the broader symbol set. So that's how we read this. So we're going to look at Caterpillar, Alcoa, Visa, and Walmart for sure. All right, that's everything I want to look at on the daily report. Let's take a look at some charts of interest then. All right, so Chevron is one that's of interest we were talking about just briefly ago. And what I want you to notice is that the, if I can draw this with my highlighter, there was a moment down here when the RL10 on the 16th, earlier this week, that the distance between the 270 and the 10 period regression line had gotten to an extreme out here, and this is such a fantastic short-term divergence that, I mean, I look for these kinds of opportunities almost by default. I mean, this for me is the simplest one. It's not really a pattern, but it's really just an opportunity. Is on the one hand you have this Z trade developing and have had it for a long time. and now we have a 1, 2, 3 entry. You can look at entries here at 106.50. You might try the entry at the Z plus 2 entry would be 101. Entering at the Dragon would be about 104. You should see the you should be seeing some a blue pen markup. Is it not showing? Doesn't look like it's showing. All right, can you see the red ball again? Let me try unfreezing this. Hold on. All right, let me see. Can you see the highlighter now? I'm highlighting the distance between the 270 and the 10. There we go. Okay. So what you have here is when price is down in this channel, it's between Z minus 2 and Z minus 3. So there's a Z trade opportunity in all of these. And then, let's see if it'll take the pen now. Yeah, there's the pen. Okay. So at this moment down here, when that 10 starts to curl up, this is telling you that maybe the reversion to the mean is occurring. So we set the 270 as the price target, and we also use the return to the Bollinger Band mean as a target, and buying not later than re-entry to the river, with the opportunity to buy at the edge of the river or when it emerges from the Dragon. Or if we can buy this, we might be able to buy this entry here. So this distance from the 270 to the 10, if we were to, and I don't know what the ATR is on Chevron, but it's probably something like that. That would give you something like, if that's what the ATR was, this would give you something like a 6-to-1 reward to risk ratio. If we simply were to buy one ATR off the bottom, that would tell you that there's 6 available to the upside. So we're measuring the distance between the 10 and the 270 on that regression line fractal. Okay. Now on the to look at one on the upside, I think it was, if I remember, Visa was the leading candidate in the Dow. So we'll take a look at that one. There we are. Yeah, now you can see on Visa that the price has moved that far away from the 270 already, and so that's a measure of this whole price action in here is a measure of the relative strength of Visa as it has pulled away from the previous long-term estimate of value. So actually, one of the things I like to do is, if I can get this back here, let me expand this a little bit and erase those drawings. Something I like to look for are these moments in here, in that big blue circle that I just drew. This is a moment when the 270 regression line and the 10 were in tandem, and everybody was in agreement on what the fair value of this rascal was, and then you got this nice bolt up in Visa, and so what that lets you do is start saying, oh, that has started to pull away from that 270 regression line, and all signs point to yes. So you got to hold your nose and buy in this price extension, and that strength has really stayed here this whole way. And so Visa right now, this posture is still, even with this tiny little pullback here, this strength in Visa is the best performer in the Dow. That this is like 3.5 ATRs north of its regression line. This move was strong enough to take a regression line that had been fading and has now turned this to to start to move up. So the long-term indication on Visa is strong. This little recovery and move is good to go. If it gets above 268, then it's free and clear, and off it goes. So that's the strongest relative strength in the Dow 30. Walmart was another one. So let's take a look at Walmart. You can see almost the same kind of a pattern in Walmart, where the last time in this sideways quiet channel, the 270 and the 10 were all in agreement about what the value of Walmart was. And then you get this explosive move out of the river here, and the dragon leaves the river. So we have to be figuring out how to buy in here, especially when it's leaving, when it clears the previous high. Somewhere in here we've got to be able to buy this, or we can start buying this now in here. But now the distance between the 10-period regression line and the 270, this is about, I think it was 3.5 or 3 ATRs north of the 270. So that's what a relative strength leader looks like. Then again, on the other side, when we're looking at the ones that are suffering the most, let me see if we can find one here. Yeah, let's see. Caterpillar, Alcoa, and IBM. Let's take a look at those three if we can. So Caterpillar. This is really a really nice posture here. We're still early in the move on Caterpillar. If it holds in this price level in here, take that as the sign of bottoming action. Now what we're looking at in their fractal framework is the distance from the 270 to the 10, which has started to turn. So really, if we get any price above 92, then off we go with the stop down here, and with targets in that range. So that's Caterpillar. Let's try IBM. Let's see, we may have already missed the easiest move in that, but again, on the day that it had its biggest divergence was here. In fact, we can't even see the 270 on this scale. Yeah, that's how bad IBM has been. Yep, so here was the move. The long-term fair value of IBM is, 176 and dropping. And here's how I interpret that. This move that we had over here that failed, when that was occurring, long-term fair value was somewhere around 190. And then the fact that it has failed to recover, for 45 days, now the opinion of the long-term holders about the value of IBM is decaying. You can see that's the RL270 is coming down. But there's still a healthy move in here from the RL10 back to the 270. And now the way I interpret this is that price, if this really is a bottom, maybe price is going to look like this, and then the 270 is going to continue to decay, and so maybe that looks like this. So I now take that, I use a little just chart geometry, and then I put my what I think of as fair value out in here, right now to be about 170. So if it were to get from 158 to 170, that'd be a nice move. So you can build your little price targets here at the Bollinger Band mean, Z plus 1, Z plus 2, Z plus 3, and that's sort of a rebound, and just on a return to fair value using that fractal framework to find extreme conditions, and then using our stats-based measurements to find price targets in that price ladder. Let's take a look at Chevron. Yeah, oops. You already have to be in that trade. Again, so the 270, the divergence between the 10 and the 270 is here, and you can see the rebound, how fast that can occur. I mean, that's a 12% move in 4 days. And you don't have to get all of that, but if you know which ones are at extreme conditions, there were some opportunities in these big white candle days, intraday, to get this one here, and then this one, to get some really nice moves. And those are ones where you might want to just leave a piece because you know that the long-term fair value estimate of this thing's up around 120, and you're able to buy it somewhere between 102 and 110. So that's how I'm using the fractal framework. Let's see, we wanted to look at silver, I think. Or let's look at Latin America, because that's been punished so broadly. Latin America is in great shape here using that fractal framework. Again, we have a nice divergence from the 10 to the 270. So fair value's up here around 37.20, and we are just now back into the dragon with this little rebound. So I can still frame this trade nicely, this way, entering north of 32, and then with targets at Bollinger Band mean, far side of the river, far side of the floodplain, as a 3-to-1 opportunity. That looks good. Let's check our old buddy Cliff Natural Resources. Oh, even better. Here's a trade frame already built. So we have a nice distance from the 10 to the 270 here. So fair value is up around $8, and I'm ready to buy it at 6 3/4 with a 50-cent initial stop, and ready to. And then if it leaves the dragon here, that makes a nice place to add a second position. My target would be here, and then at the same time, this stop here at 6, or even below yesterday's or Friday's low. If it violates below here, then that becomes a short. So we have a really nice postured trade here. What I really like about Cliff is just what a smooth and orderly swing trader this thing is. It gives you lots of time to consolidate your gains and get out of trades. And then you can see where the dragon rolls over. Now I'd like to see a little bit of stability here. If the dragon were to curl up, and that becomes a nice swing low, and now I can play back to fair value of somewhere around 9-ish. Okay. All right, so that's everything I want to cover today. We're heading up to Michigan to visit family on Tuesday, and so I'll be up there. We'll have one more day around in Kansas tomorrow, Kids are already up there working on helping my sister get her house ready to sell. So they're learning what hard work is like, how to recognize it when it happens. I sent out a note to everybody about about IITM is very close to releasing the beta version of the swing trade workshop. We've recorded the last, I guess, 2 or 3 of them, and then they've assembled that into the highlights or the best of, and it looks pretty good. And they're soliciting some beta testers right now. So if you're interested in doing that, I sent a link that you could sign up for that in the weekend email. It's a pretty good deal for beta testers. I think they'll get a chance to review the whole package for $9.95. That's a package that IITM is going to sell for $2,500. And if the core course is any indication, there will be 100 or 200 people that ask to be beta testers. So but they're only going to take probably not more than 10. So if you're interested in doing that, again, just hit the link on that. That was to the survey that was in that email, and then I'll get your names high on the list to IITM and get you in the front. I think it's a chance to do some work and then get a pretty good product at a great price. All right, that's everything that I wanted to cover. So take good care, and we'll see you in the chat room. Keep your wrist measured and your powder dry. Take good care of yourselves and your family. Enjoy these holidays. Be safe, and let's raise our energy and get ready for the new year, and get ready to get after it again. So take good care, guys, and we'll see you in the chat room. I should say I'll hang this as soon as the recording is done processing. I'll hang this in at YouTube. That's all from Kansas. Take good care.